Welcome back to Trade with Conviction. It's Thursday, February the 26th, and I'm your host, Neil Crosby. Today, I'm joined by my esteemed colleagues, James Noel Beswick and June Go. Hi, both. How are you?
Yeah, very well, thanks.
All good, thank you.
June, you've had a very busy day, I understand. I woke up and found half a carcass of a squirrel on my terrace. So that was my first job today. I don't know what it was. Maybe it was a pine marten or a crow or something like that, or a cat. Anyway, a far different experience than you've had today. 6 hours ahead, you've been doing real work. All right. On that note, let's kick off our usual section, Geopolitical Corner. Obviously, the focus this week has clearly been Iran, with talks underway pretty much as we record in Geneva, amid the largest American military buildup in the Middle East in many, many years. Iran is reportedly offering to do a few things, but various red lines that the US has on ballistic missiles, for example, are not attracting much traction, let's say. And there's the explicit threat of military force consistently on the table. I saw this morning, actually, that Iran is potentially going to offer what's called a commercial bonanza to US companies in Iran with investments in oil and gas reserves. That piqued my interest just because it seems like a familiar playbook in Venezuela. And very cynical of us, I suppose, these days might suggest that this was part of the plan all along, in a similar way to what Venezuela might have been. Shades of kind of oil imperialism popping up again.
Yeah, well, it's a story that is single-handedly dictating the flat price of oil at the moment. Even if front time spreads for Brent have actually weakened drastically. But to be honest, it's basically a binary outcome from here out onwards regarding price direction. If diplomacy fails and US airstrikes materialize, crude could violently spike towards $80 plus per barrel within the first 24 hours, with more to come thereafter depending on which escalation scenario happens from there. Now, if a deal is rumoured to be close to completion, expect that risk premium to wash out and send prices much lower. And watch out, of course, for the fact that CTAs are very long currently. And we aren't just talking crude either. We have seen the usual geopolitical upsets in, for example, diesel and naphtha markets, namely very, very wide east-west spreads. And the major one also is freight, with dirty freight rates absolutely soaring, even from already high levels this week.
Yeah, and the next one, we'll move into a few of those as we go on through the day. But the other one was obviously the Supreme Court ruling on tariffs. So global trade was, in essence, upended this week after the court ruled that Trump's tariffs were essentially unconstitutional. That sort of invoked a response. It was planned to be 15%. In the end, we got 10% global tariff for the next few months. And for Trump, really, I guess it is fair to say it's a bit of a political disaster. It only creates more evidence for the story that peak Trump has already happened, whereby Trump's authority is weakening just as his approval ratings are rock bottom and with the midterms around the corner. So he's lashing out a little bit with the flat emergency rate, I suppose. And it really creates potentially very important complications for recent trade agreements in Asia, particularly involving oil. So the US-India Pact, which we've talked about for quite a few weeks now, was announced only really this month or last month, in which India agreed to, India was sort of purportedly agreeing to massive American energy purchases, potentially including Venezuela, and all that would involve dropping tariffs down to 18%. Now that is all completely clouded as the baseline rate has dropped to 10% for them. So all this negotiation has proven to be in vain. And it's the same for everybody around the globe, right? Recall sort of Swiss negotiations involving bringing a gold bar with the engraving on it and stuff. And all these efforts are in vain, right?
Yeah, I think on China. Yeah. So China suddenly receives a relief from the harshest emergency tariffs. For the next 150 days, the US will either have to accept this lower global rate or rush to build new, slower sector-specific tariffs to regain leverage over Beijing and New Delhi. And then for oil side, there is a lot of uncertainty now regarding the recent trends that we've been seeing, particularly around Indian buying of euros and whether the partial rejection of Russian crude might actually stall and reverse course. It could still be that India reacts slowly for now, particularly as they are also drawing closer to Europe geopolitically, as well as other middle powers. Obviously, Europe wants pressure on Russia to remain high, but there's a chance that India reverts to more Russian purchases, in which bye-bye AG spots market strength that we are seeing right now. On the China side, while an immediate unilateral tariff reduction from Beijing is unlikely, it could be that US crude is becoming a Chinese weapon in a way. Trump is scheduled to visit China in late March or early April 2026. And Beijing might use the promise of energy purchases as a carrot in exchange for Washington agreeing to keep the new lower baseline tariffs permanent rather than launching fresh sector-specific attacks. Until that summit, expect China to hold its fire and keep American crude imports paused to maximize its leverage.
Yeah, and the last thing just to round this off this week is just amongst this giant mess is kind of went under the radar, I suppose, is that we're getting a new OPEC Plus meeting at the weekend. The rumor mill now suggests they're considering a small token hike of, say, 130 kbd. There was a couple of weeks back, there was a headline that said some members might be considering raising supply again. I think that was partly to test the market reaction. But it's not a true test at the moment because the whole market's bid up on Iran anyway. So that's not really a fair test. Something like 130 wouldn't move the needle much on the physical market, but I think it's a bit of a risk under most scenarios that don't involve an Iran conflict. And I mean that in the sense that, yes, flat price is relatively higher than it was, but the physical crude market, I think, is still very unhealthy relative to this time last year, unsurprisingly. And even the sort of strongest part of the crude barrel that we saw over the last month, probably a month, which was the North Sea. And we've been talking about sort of window games in the North Sea for quite a while. Even that is now cooling off, potentially an unwind of this bull play, but also it had to come off at some stage basis physical diffs elsewhere in the world, basis ARBs, and just basically reverting to some kind of mean levels. So I think the physical crude market is already quite satiated, so to speak, and a big supply hike would be a bit of a risk for OPEC. But, that might not be the biggest concern for them just now. And maybe they know something that we don't on Iran. Okay, let's kick off our bread and butter segments. Why don't we move to the physical markets? James, distillate, where do you see things in distillate at present?
Yeah, where are we in general with distillate at the moment? So, as we've been discussing for a while and predicting, to be fair, everything is so strong and also kind of really extreme in global diesel and jet currently. We've had the resumption of Russian refinery infrastructure attacks. We've got global maintenance underway in the US Gulf and starting in Northwest Europe and also about to start in Asia, Middle East and East Asia. We've had bouts of cold weather at the beginning of February in the entire Northern Hemisphere, Asia, Europe, America, and Storm Hernando in the last week or so in the northeastern US. And of course, as we've kind of discussed earlier, the chance of military escalation in Iran kind of weighs over everything. So we've got heating oil, ice gas oil, syn diesel, all backward until well into 2027, with Singapore kerosene and Northwest European jet much the same. We've got particularly March heating oil, but also ice gas oil and syn diesel cracks in the case of heating oil, but in the case of ice gas oil and syn diesel, very close, pretty much at the seasonal maximums, with again jet cracks in Europe and Asia following. Everything in the diesel and jet markets at the moment just seems really extreme. So we've got both the gas oil and jet east-west at their seasonal widest over periods of the last week and currently for like at least 8 to 10 years. Although the jet east-west, to be fair, is somewhat narrowed over the last few days. Even the spread between like MOPAG and Singapore is very close to seasonal width currently, only surpassed by like the extreme years of 2023 and 2024. Again, even the regrades, we've got Northwest European jet regrade, Singapore regrade to diesel at seasonal heights. We've got the Widowmaker to gasoline at seasonal widths, historical widths. The GOFO at historical seasonal widths as well. And even freight, TC5, TC14 are really, really elevated, again at their seasonal maxes currently now as well.
Okay, yeah. So a lot of bull factors come into play over the last, I'd say, 1 to 2 months, plus the introduction of Iran as a sort of increasingly likely tail risk, so to speak. How does that shake out in terms of the ARBs then, James?
Okay, well, actually, somewhat surprisingly, US Gulf MR ARBs to Europe are open or very close to open, despite the width of the HOGO and that discussed strength in TC14. Actually, the US Gulf diesel differential is very, very wide currently. Stocks in pad 3, in a real contrast to the prices in pads 1 and 2, essentially, are at the top of their seasonal range now, pad 3 stocks, diesel stocks. We've got, because of that strength or the width of the gasol east-west, we've got Middle Eastern ARBs, AG, West Coast India, for diesel, and jet actually, pointing firmly west. That's mostly due to the strength we've seen in the ice gas on heating oil that's kind of widened the gasol east-west. And again, well, I think something interesting to mention is also that Europe's taken again diesel and jet cargoes from India is an important point here. We've got, as I kind of just spoke about, but adding to that, East Asian jet ARBs remaining open both into Europe, but also into the US West Coast. This is despite the strength in Singapore regrade that we discussed earlier. And the real driver here, again, is that earlier discussed width in the jet east-west. That's a key driver here. And the ongoing issues at El Segundo and the closing down of Benicia refinery soon as well. And we've got North Asian diesel ARBs closed into Singapore currently, despite the strength in Singapore diesel pricing. And that's perhaps a portent of the turnaround starting in Taiwan and South Korea, I think towards the beginning of April. But also poor refining margins in that region, largely due to the weakness in seeing gasoline, but also the strength we spoke about earlier in the dirty freight market.
Yeah, so I'm getting the picture that generally speaking, in the distillate market, you've got a bunch of stuff opening up into Europe. Typically speaking, that will prompt us to get a bit more bearish on European type of distillates. Is that how you see things in terms of trade calls?
Yeah, definitely. I mean, everything feels so strong. It almost feels a little bit hard to get a bit bearish now. But yes, I guess I do have that call. I guess maybe a slight decline in ice gas oil spreads and cracks from here, not to fall too low. But we've got, as you say, diesel ARBs from both Asia and the US workable into Europe, increasing the margins. So I describe it as more of a ceiling than a decline in the ice gas oil spreads, because we've got like a number of caveats to that. We've already spoke about US Gulf refinery maintenance, Northwest Europe, AG West Coast India, East Asia. And also joining along with East Asia, Northwest European refining margins, again due to gasoline's weakness, or largely due to gasoline's weakness, look really poor from here.
Yeah, I would just maybe caveat the margin thing. We should make some distinctions here. So if you look at the short haul cracking margins into Europe in our physical crude delivered margins, they still look okay. I was looking this morning. In fact, they've strengthened a fair bit, but we know that gas oil cracks are up, right? Which kind of makes perfect sense. It's more the long haul stuff into Asia where the cracking margins on TI and WAF and North Sea are negative, and also the sort of spot AG delivered margins into Asia, those have compressed a fair bit. But the sort of base load globally is still all right, I would say. It's just that that will move the needle. The weakness in Asia will move the needle on the crude market in the West, and it could move the needle on distillate supply in Asia in the next 1, 2, 3 months.
Yeah.
And that obviously has a knock-on impact for distillate in the West. And you combine that with strong maintenance in Saudi and India in March and April, and then you come up with a picture of, okay, so maybe supply does look tighter than we perhaps thought in Q2.
Yeah, thanks. That's a really interesting point. And just to kind of wrap up on that as well, I guess I could see a little bit of an argument because of those poor refining margins, partially for maybe some strength in Singapore diesel spreads and cracks from here as well. Allied with that, the closure of Singapore or North Asian ARBs into Singapore, and also the pointing of Middle Eastern ARBs increasingly west as well. So maybe a slightly bullish call on both Singapore diesel spreads and cracks, and also the gasol east-west. And I guess also Singapore kerosene spreads and cracks feel a little bit bullish from here as well. And although it feels hard to say it, I guess I'm still bullish the Singapore regrade from here as well. So we've got Asian jet ARBs open east and west, and again, those poor refining margins in the region as well. I wanted to wrap things up there, but I think I kind of got through that.
Yeah, no, I think all this needs to be caveated as well. Like if this was a normal situation, it would be quite easy for us to say, okay, east-west is surely going to correct. It will get narrower eventually because the arms point west. But it's not a normal situation. Of course, a lot of this is caveated with the Iran stuff, right? So if Iran does escalate, let's say, then it will tend to favor the natural short, which is Europe for distillate. And that's a slightly different story on crude, right? There will be a geopolitical premium on Brent, but actually the barrels at risk are Dubai linked. So eventually you have to think about a slightly different picture on the physical market for crude. Anyway, thanks very much, James. Let's talk crude and resid and margins. I'm going to pull you, June, in here. What's the updates here? I think one big factor, the biggest talking point in the market has been VLCC rates. How is that impacting crude?
VLCC freight rates, they have literally shot to the moon. I have no idea when the spaceship will come back down to Earth. We started this year, TD3C, which is the Middle East Gulf to China route at world scale 71. That's roughly translating to about $2.10 per barrel freight cost. And that same route now was printing world scale 213 today. That's about $6.30 per barrel freight cost. And that's exactly 200% increase in 2 months. I actually thought it was 100%, but actually it's 200%. Charterers now have to swallow that incremental $4 per barrel freight cost. And do they have a choice? So let me step back and explain why this is happening. There are many fundamental drivers. We first already noted, back in Q4, OPEC Plus was hiking production. And alongside that, we had the supply growth elsewhere. For example, Brazil, which is responsible for a lot of the ton miles heading to China. Venezuela barrels also goes on a longer ton miles on a legitimate fleet. India rotating out of Russian crude, going into the AG trade. We have the big news on Sinoco rapid consolidation of the 40 plus VLCCs, concentrating ownership and reducing the odds of price capitulation with the rest of the freight market.
Okay.
Then you got, the embedded risk premium for AG port calls moving higher due to the Iran risk, and owners need more compensation to take that voyage risk. And additionally, front loading of crude from the Saudis that we have seen in the news now. Bahri, which is the Saudi Aramco linked shipping company, has snapped up at least another 5 super tankers, even at the current 200K per day rates. So, there's so many things going on fundamentally that we are going to see definitely a higher low and a higher trading range in global VLCC freight rates versus past years.
Yeah, and that's something we were talking about also in our little live pod event in London. It's difficult to see what the solvers are for this now. It feels like we're structurally higher. We've got, just the market has changed. There's people hoarding tankers. There's much more supply on the market. It's very difficult to change that unless flat price really tanks and OPEC decide to cut back 1 million barrels a day of supply or something like that. But generally speaking, a lot of these things are a little bit structural now. One caveat there, if Iran de-risks, there will be a decline in rates, right? There will be a risk-off move. But for now, how is this impacting refiners? How do they react to this? What's happening to margins?
The 2 words that come to mind, poor me. There's a glaring $4 incremental cost that was not provisioned at the start of the year. And refineries rarely hedge freight. So I'm sure they are hurting. However, the crude that they've committed to, they've bought 1 to 2 months ago, that has to be loaded on a ship. So end users will unfortunately need to swallow the current rates. What happens next then? Refineries running their LPs right now for their forward crude buying will start thinking twice about running at higher throughputs. The base volume that they need to run will remain intact, but if the DPP rates goes up unabated, then refineries can well look at this negative simple margin on their marginal crude buying and say, thanks, but no thanks, which is the case, I believe, for light crudes into Far East, and I call that the marginal crude here. And if paper EFS and freight don't or won't correct, then crude premiums will have to, given turnarounds that we're going to see and margins, particularly in the West.
Yeah, I think you already saw that this week, right? I mean, it's difficult to dissect exactly what's been going on because there have probably been window games in the Brent market, but Brent premiums already cooled off. The March DFL is now negative. Haven't seen that in quite a long time. WAF has started to cool. That's typically something that's a bit sticky in terms of the FOB diffs. So it is really, there's kind of two solvers for the margin thing, right? The physical crude premiums need to come off, or something might have to happen on cracks. So I'll let you continue.
Okay. So on the crack side, we got to see how it pans out for the crude buying window, which is now 2 months ahead. In the short term, as James has talked about quite a lot just now, the gas oil and jet are very well supported. And we also have the impending turnarounds in our region as well, with India having close to 1 million barrels per day CDU turnaround in April. But just to remember, right, the impact of the heavier crude slate globally will start to permeate through the product markets from Q2 onwards. And I believe that will temper the strength in cracks that we may be seeing for middle distillates now, while also providing a mild support for the light end of the barrel.
Yeah, I mean, I think I see it slightly different in terms of what that refers to is the difference in relative cracks, right? In terms of which product is produced. But the question here is whether it makes now sense for the product market perspective as a whole for some margins to be too low in the world, right? Do cracks, let's say, can products afford for run cuts to happen? If not, then the cracks will also have to respond. The average level of cracks, which is the margin essentially, right? So I think those are two distinctive points, and we'll find out. I mean, one of the things we said in the live pod was we haven't seen demand capitulate in the end user market yet. We don't see many capacity additions coming up, and if they do, there'll be an H2 and there'll be always some slippage risk. And so we've been saying for quite some time, we should probably buy dips in margins because we don't see what's changed. We haven't seen a huge build-up of product. So yeah, it could be a response on the crack side and the physical crude diff side to help restore order here.
Yeah, very good. Yeah.
Okay. I had a point about MoGas, but in Singapore, the cracks and spreads currently from a low. We've heard Pertamina issuing multiple gasoline tenders since the 19th of February, and the Malaysian refinery PRefChem has suffered from another unplanned RFCC outage. So MoGas in the east looks for now having further upside, particularly as we enter the turnaround season in March and April.
Yeah, very good. And you've seen some of that in the east-west as well, some kind of recovery in the east-west. So maybe a bit more evidence for what I'm talking about, right? Immediately some kind of crack response in the east on gasoline. Okay, let's go back to our ARBs. What are we seeing now in crude, North Sea, WAF, ARBs?
We talked about some of it earlier. North Sea and WAF premiums, they are now finally coming under pressure. Brent's physical and paper weakening is accelerating, with North Sea and WAF light sweet premiums now down 50 cents week on week. DFL's ICE Brent spreads are also down strongly. This is all caused by returning supply, turnarounds, lack of Iran outages, and the closed ARBs East last month doing all this damage, while rumored bull plays in North Sea was helping to hold the physical premiums up until now. We're going to look to CPC for some kind of endpoints for physical premiums in the West. CPC is scoring a 10 in our signals into Far East, albeit on Suez Max basis. For example, for WTI on Suez and VLCC to FIs are now roughly at parity. 10 means it is very cheap. And 40s and WAF premiums still have work to do to fully open ARBs East. The direction of the travel is clear. Agbami Far East on Suez Max has moved from $4 per barrel overvalued at the end of January and now minus $1 per barrel versus the basket.
Good stuff. So the direction of travel is clear. The West is starting to weaken and trying to open up new outlets. What about Murban? Since it's obviously linked in terms of those are its main competitors. How's Murban scoring?
Murban is now at a 2 in our ARBs dashboard, which is expensive, largely on freight gains. Premiums to Dubai is actually easing. Murban premiums were earlier tied to the CPC outage in January, so they had a bit of a support there. But I want to put on the angle about the light crudes benefiting from Indians taking more Venezuelan crude. Mary, for example, has about 62% long residue. I call it LR, or simply fuel oil yield. Urals or Arab medium, on the other hand, has about 46% LR. And this to me is the medium body crude, which is a good design crude for the refinery. If the Indians are backing out Urals, they will need to blend Mary with a lighter crude that has lower residue yield to make a lookalike to fulfill both hydraulic and quality constraints of the secondary units in the refinery. So a 50-50 blend of Melbourne and Mary seems to do that job well, maybe even a higher skew of Melbourne to manage the nitrogen and metals constraint in some of the Indian refineries. I caveat that because Reliance by itself, it has amazing flexibility, so they are not going to be constrained by likely the quality issues. So Melbourne gets a happy demand uplift here for this reason. On top of that, we have Melbourne and Oman load ports sitting strategically outside the Straits of Hormuz, so that can command a higher premium if tensions escalate again in the Iran side. But for the rest of the spot AG market, we are going to expect this to weaken from here unless we see the Iran conflict beginning.
We've got to caveat everything. Unless Iran happens, XYZ may happen in the next few weeks.
Yeah, so which side of the fence will you be on?
Well, it would be very easy for us to sit here and say, "Oh, I've read something very interesting of what Trump's going to do in the next week." But the success of that is very limited, as has been proven in the last couple of years. Thanks very much, June. So we can kind of say spot AG likely to weaken unless Iran happens, and probably more room to run lower in Brent-linked crude as well.
Yep.
All right. Thank you very much. Let's go to quickfire. I'll just take us through a bit light ends and fuel oil. We already mentioned a couple of things, right? So the East-West, the gas East-West has a bit of a reputation for being driven by games in the Singapore market, window games. Certainly that was the case over the last couple of weeks as we've been talking about. But it clearly found a floor, and maybe perhaps for pref-chem reasons as well. The March East-West had been rising sharply since we called for it. But on the ARBS basis particularly, it looks like the East-West, Q2 East-West still looks like a solid buy at -6 from here. And the other thing is that the EBOB spreads have indeed moved out of some of the deepest contango levels we've seen in quite some time. And what it did was it actually started to close off some of the storage options for a few days, but then we have actually seen the physical market, we're talking about reformate, premiums, cash diffs, they've been moving to try to reopen those econs. So not something to be taken as a real sign of clearing up the length. The physical market's actually moving to reopen the storage for the summer. Okay. On the fuel oil side, I'd say that's one of the more interesting stories and relates to a lot of the stuff that we have been talking about for the last half an hour. So the main thing being the Singapore 380 spread, March-April, has fallen a lot over the last 10 days, weakened very substantially. And the physical market in terms of cash diffs also moved down with it from double-digit territory back to low single digits on a dollar per ton basis. And that actually took a lot longer than we were initially thinking, particularly Hua, who's driving our fuel oil analysis. And I think that one of the big new problems, apart from the fact that there's more resid around in general from the sour crude supply side, is the introduction of Venezuela. So on the pricing basis, Venezuela is likely displacing external resid needs in both the US Gulf and in India, because we know there's at least about 200 kbd of Venezuelan stuff now heading to India, which displaces Russian HSSR. And there's also strong signs that the structural supply demand is shifting a little bit. We're looking at kind of Saudi oil burn data for Q4. We had the Jody oil data coming out for December, which gives us a Q4 view. Combined fuel oil demand and direct crude burn was down 150 kbd year on year in Q4. And that's sort of relatively more weather independent than in the summer, I would say. And most of that was fuel oil, although they're kind of interchangeable. So there's a bit of that's the Saudi liquid replacement story kicking in there. And what needs to happen now is we need some upgrading kits to try to clear some of this length in displaced HSSR. We've got a few proxies for that. One of them is the TI HSSR landed blend, and that's still at a bit of a disadvantage to spot medium sour crudes. But if you are a Japanese or Korean refiner, in particular looking to fill up your cokers, you're looking at some of these kind of Gucci grade Saudi molecules to fill up, and presume pricing just needs to do a bit more to try to open that outlet. The other option is the Chinese refiners. They can technically do the same thing, but at the moment they probably won't because they still have access to the plentiful Russian HSSR as well. So we'll see. Looks like the 380 market is weakening. There's this sort of strong litmus test coming up for summer burn pre-stocking, which usually starts in April. And there we'll get to see really how much that can rescue the market. But it looks like the fundamentals are weakening in the 380 Sing market just now. All right, guys. Thank you very much. Pleasure again to have you on the pod. And we will see you all in due course next week. We'll see what's happened on Iran by then. Potentially everything, potentially nothing.
Thanks again, Neil.
Cheers.